Good morning, everyone. Thank you for having me. Thank you for being here. Yes, as Madison said, I'm Alana Maxwell. I'm a partner with Caliber Accounting and Tax. So our office is just down the road here in Pismo Beach since 2008. And today I just was going to talk to you guys a little bit about what we can do to streamline accounting processes, and then also just a little bit about managing due dates, deadlines, those sorts of things. So we'll get started here. Certainly, if anyone's having trouble hearing me, let me know, or let Madison know through the chat. And we do have time for questions at the end, but also welcome if you guys have questions throughout. That is fine as well. Okay, so first here, just have a slide up. We work with, range of businesses that really goes from sole proprietors working out of their garage all the way up to corporations with thousands of employees, that are across multiple states that might be going through some sort of sales transaction. And obviously, as you get bigger, you're looking at accounting, there's more, more schedules, more information, more numbers to deal with. But as far as streamlining processes, like so many other things, it's all about like starting small and building just that foundation with kind of the simple things. And if you do that as you're getting started and just kind of keep those same practices, then that's going to really see you through your growth cycle. So so just some basics wanted to go through for streamlining those accounting processes. Obviously, it all gets to the data. And from my standpoint, a lot of times, particularly when businesses are getting started, they're so concerned about, am I putting this in the right account? Am I using the right software? And all of those sorts of things. And I feel like a lot of that will sort out if you can just make sure that you've got your data, you've got access to your data, because as you work with people that are in the profession, if you can give them the information, I mean, we kind of live and breathe this stuff, right? So that's what we're doing every day, is then kind of manipulating that data. And I don't mean like manipulating it to get the result you want. I just mean manipulating it to, if something's posted to the wrong account, we can get it to the right spot. You've got all your income and expenses, but it may not be, in the software we want. Those are all things that we can help with. But what's hard from kind of accounting, professionals that are outside your organization to help with is that if you don't have the underlying data, it's very difficult for us to then kind of help you, get things into what may be a more usable format that you can use for, management decisions, as well as for things like filing tax returns or whatever compliance needs you might have. So basics there are just kind of number one, build it, which is just making sure you have your data. Number two is just kind of keeping it, making sure it's organized, because if you have it, but you can't find it, you can't produce it when somebody's asking for it, then that will impede things as well. And then number three on there is to just utilize it. And focus for me there too is, yes, your accounting professional, other people may be asking for your data for certain needs, but really as the business owner, you're going to be the one that's using that data the most. So the most important thing is to make sure that it is useful for you. And if it's, again, useful for you and you have the data, other accounting professionals that are working with that can kind of extract from that to take what they need. So then we're going to go into just a little bit more detail about each of these. So number one on the build it points there are just to have contemporaneous records, meaning that obviously if you can keep track of things as you go and not let it all build up, that's going to be a lot easier. So I have the idiom, on there of how do you eat an elephant, right? One bite at a time. So just kind of starting and building that. And again, like I was saying, as you get bigger, there's going to be more schedules and such, but it really gets down to, receipts bank statements, credit card statements, again, as you grow, and if you've got, asset purchases, loans, certainly there's documentation, behind all of those things that will be important as well. And then at the bottom there, just something to think about as well, is from taxing authority standpoint, in addition to, the underlying receipts, bank statements, credit card statements, if you are in a situation where they're asking for more information in some sort of examination, they're also going to be interested, right, in the who, what, when, where, why, and how. So in addition to having those receipts, particularly things, mileage, meals, those sorts of things, it's also important to kind of have records of what the business purpose is for those items, in addition to having the underlying statements. So if we go on to number 2 here for the organization, just some thoughts there, just the way things go, right? Most people are kind of all over the place in different places. So the extent that you have a solution where you can kind of access those documents from wherever you are, it also then usually makes it easier to share those with others. And, there's lots of resources out there to do that. I mentioned a couple, a couple up there that may be helpful tools there. And that bottom note for assuming an audit 3 years from now, really that is something that we use in our organization as just kind of a training mindset. So just that when we're keeping records is as you're doing that and you're building your files, to think about it that somebody's going to be asking you about this, 3 years from now when you're not going to remember exactly what you did. And so just kind of a standard for building files so that everything is documented so that you don't necessarily, right, you don't have to have that in memory. You've got it documented, you have everything you would need right there. And then just some thoughts on number 3, which is utilizing the data and just from taking the priority of making sure that it's really usable for you as management and as part of managing the business so that you can use that data to make the strategic decisions for your business. And so that may be just in ways through how you have your chart of accounts organized to using memorized report features in your software, obviously budgeting, budgets to actual, being able to have tools that do month to month and annual comparables. Those are usually the things that are just going to give you some of that data that you need to monitor your business. So that all sounds really great in theory, right? Probably not as easy in practice. So some of the challenges that we see in doing that is just as you're developing your business, it's often very hard. There's so many different aspects to focus on. And obviously, a lot of times accounting is not always highest on that list. So sometimes it's just a challenge to have the resources both in terms of time and cost. And there's a lot to navigate just between taxes, compliance. I mean, it's always changing. And the time that it takes for someone, that doesn't work in that avenue on a daily basis is probably going to be a lot more than someone that does. So I just like to remind people that when they're looking at the costs of these things and having outside help of that, of just to make sure that in that equation, they're also considering what the cost is that they're trying to do these things themselves of, preparing forms or researching of what is that cost to your business for that time of yours, that it's pulling away when you could be, out, developing or spending time with clients or, whatever the other aspects of your business are. So just want to make sure that that is factored in when you're, evaluating those decisions of, can I get someone to help me? What is that gonna cost me? Another thing on there that is a little bit of a challenge right now, and some of you guys may have experienced this, but particularly locally, it's very difficult to find CPAs right now that are taking on new clients. I am here today, and we do a lot with SBDC and Hot House. We do office hours, trying to help people where we can. But we are also in a position where we are not taking on new clients. And a lot of the people that we used to refer people to as well have told us that, they aren't either. So I am aware of that. And it's a real problem. And then we're going to go on to talk about some solutions to some of these challenges. One thing that I think can be helpful is just upfront recognizing that it is complex to just kind of navigate all of the different compliance aspects. And I think that sometimes, again, business owners are busy and they're just like, oh, it can't be that hard, and then kind of get pushed up against deadlines and trying to figure things out. So just kind of a upfront of sometimes, yeah, it can be more complicated than it seems. The next point there about the investment being front loaded, and again, I know it's difficult, and they're just particularly at startup levels may not always be cash available. But I think you will get return, on investment if you get the right kind of professional advisors lined up from the beginning. Um, and there is some kind of upfront investment on that just to make sure that things get set up correctly and that initial filings are done correctly. But I think in the long run, it's going to end up being less expensive and more efficient for the business. And then the comment about using your networks is just a little bit of trying to navigate that solution of it being difficult to maybe find CPAs and some of those other professional advisors, and to just really use your contacts, because either someone or someone who knows someone, using resources like the SBDC. If you can utilize office hours, through the Hot House. And it's not always enough to get everybody, the detailed help that they need, but we try to at least then point people in the right direction, and there is no charge for that. So just trying to make the best use of resources available to you. So I just have a quick example on here that is just meant to reiterate the point that the compliance can be a little bit difficult to navigate. So I work with a client, and it's, just a husband and wife owned business. In this case, they happen to own an orchard. And it just, seems that it should be a lot more simple, but just something like that, kind of just small business, they deal with a lot of compliance. So they've got the CDTFA, which is the California organization that handles sales and use tax. And so they've got, compliance quarterly filings there. They've got on the IRS and the EDD side. So that's going to be your payroll. In their business, they've got a little bit of an added complication in that they have both ag and non-ag employees. So then that creates some additional filings for them too. And then they have then the IRS and the FTB, which are going to be the agencies that address your federal and state income tax returns. And so just in setting things up for them, they had some choices to navigate that probably would have been, difficult for them to do on their own. But as a husband and wife business, they have a choice to whether they are treated as a partnership or treated as a single member LLC. So that had some consequences to them. And sometimes it's not always tax related things. Like in this case, they opted to be treated as a partnership because of insurance reasons and for whatever reason, and we kind of tried working with the insurance company, but they would not like recognize them as a group policy if they were as a single member LLC. So even though it created a little more compliance on their end for actually having to file partnership returns, in this case they actually opted to basically treat husband and wife as separate owners instead of as one owner. And again, the point of this is just to kind of show that even for something that just kind of seems very simple and basic, there is an awful lot of compliance that goes along with it. So they also, in what they do, qualify as a farmer. So there's some special tax benefits out there relating to some relief from making estimated tax payments. So we were able to work with them on that. And then I have the pass-through entity tax on that, which I'm not going to go into details right now. And if people have questions at the end, happy to talk about that more. But basically, that is an election that pass-through entities, so LLCs or partnerships, can make, where the Franchise Tax Board actually allows the business to pay an individual tax on behalf of the owners, and then those tax payments become deductible to the business. Whereas if they pay that personally, oftentimes those business owners aren't able to deduct basically the same tax that they're paying. So I mentioned this a little bit already, but was just talking about, again, as you're evaluating the cost of professionals, of just not to disregard the value of your time, that, to the extent you're trying to research and figure things out yourself, of just, there is a real cost to that time as well for what you then aren't able to, to do with that time. And then I talked about that a little bit too, but there is a lot of value in just doing things right the first time, because when you're looking at, having to correct filings or figuring things out, kind of down the road, that, oh, I wish I really had been set up a different way. Sometimes then that just becomes a lot more time intensive, which most CPAs bill by the hour. So everything is pretty tied to how much time it's taking them to, to do the work. So just a note here, kind of along the lines of just trying to highlight some of the different compliance issues, and really the compliance, right, is all about that. If you're not compliant, then it becomes even more expensive because you're going to get hit with penalties. So again, just walking through some of the different things to be thinking about and monitoring. And these are not new things. You've got quarterly and annual payroll tax returns. What goes along with that too is that, there's new hire reporting requirements as well. Whenever you hire someone else, you have a very short time period from when you're supposed to be reporting those hires to the EDD, and assuming you have California employees there. There's annual information returns like your 1099s. There's often annual and biannual reports and fees, and some of those cross over because some of those are more just annual reports, legal filings, not necessarily tax returns per se. And then you've got your federal and state income tax returns. Along with that, you may have requirements to make quarterly estimated tax payments. If you have, taxable sales, or you have certain amounts of purchases, you may also be looking at filing quarterly or annual sales and use tax returns. So again, just kind of some timely reminders, and a lot of you guys are probably familiar with all of this. But coming up due January 31st, you're going to have your fourth quarter payroll tax returns, federal and state. The form references up there for the federal and California forms. That I am just realizing should say your federal annual form at 940, which is your FUTA filing, not your 990. And 990 is a tax exempt filing. So. Forms W-2, W-3 also due by January 31st, as are most 1099s. And then if you've got a fourth quarter annual sales use tax filing requirement, that may be coming up here soon as well. And then I just have some due dates up there for federal and state income tax returns, which are going to vary by your type of entity. So those are the due dates for the 2024 returns due this filing season. Business e-file just actually opened back up yesterday. Not quite open yet for individual returns, but should be here by the end of the month. So those are just some due dates to keep in mind as well. So this is not a tax filing, but it's something that comes up a lot with our clients. So just wanted to spend a little bit of time talking about the California Statement of Information. So this, there's a initial reporting that's due within 90 days of registration with the Secretary of State. And then if you're a corporation, you're required to file that annually thereafter. LLCs or partnerships that register with the Secretary of State are only required to file every other year. And I think probably more we see this being an issue with LLCs or partnerships. And I think it's because with that biannual filing requirement, it just falls off the radar a little bit when you're only filing every other year. And the form itself, you just file online through the Secretary of State website. There's a $20 or $25 filing fee, depending on what type of entity you are. But the Secretary of State used to like send out those postcards, and a lot of people would think it was just kind of like spam mail. Now I don't even think largely they're sending them out anymore. So this is just something that we see that people miss a lot. And then it gets even more confusing because the Franchise Tax Board, which is the California, tax agency where you're filing your income tax returns, if you don't file on time, then the Franchise Tax Board collects on behalf of the Secretary of State. So when those notices are being sent out for that $250 late filing penalty, it's actually coming from the Franchise Tax Board. So we will see it a lot because people get anything from the Franchise Tax Board and our clients just send it to us and they're like, I thought we filed our tax returns, and we have to then explain we did. They're collecting on behalf of the Secretary of State, right? This relates to your annual reports, because those annual reports are not something that we are filing on preparing on behalf of our clients, but we do a lot of monitoring because the information is available through the website. So a lot of times just when we are contacting our clients, we might just hop on and just check their status. And if it's showing that something's delinquent, then we'll say, hey, you really want to take care of this right away. So obviously avoiding that $250 late filing penalty is nice. If it goes on too long, I mean, the Franchise Tax Board and the Secretary of State will actually suspend your business, which then starts to impact many other things. But usually that's something where you're looking where you haven't filed for a number of years before that would happen. And the other thing that I think gets a little bit confusing and why people miss this is that the annual or biannual filings are due, it's based on the date that you originally registered. So like if you registered in January, then either annually or biannually by January 31st, you would have that filing requirement. But you can actually file anytime in the 5 months preceding that date. So sometimes I feel like that wide window for filing actually ends up with lower compliance because it's such a long period of time. I know that there are a lot of entities that may have initially registered or formed in Delaware and then may also be registered in California. Obviously, there are other states that can apply here, but we do see Delaware. A lot, and so I just put up some dates there. So that's just kind of Delaware's kind of equivalent. So if so there's a June 30th due date there for an annual report and franchise tax. And then limited partnerships, limited liability companies, general partnerships don't have to file the annual report, but they do have to pay a $300 tax every year. So if you are formed in Delaware, you should be aware of that or may already be familiar with that. So the beneficial ownership reporting is something else that is not actually a tax filing, but that we have just been involved with a lot on a kind of an educational basis for our clients. We've also been working with Madison over probably the last year or two to just try to disseminate some of that information. And it was kind of a big deal before. And then I'm sorry, you have a question? No. Okay. And it's gotten more confusing probably in the last month or so. And again, if people have more questions about this, I'm not going to go into a ton of details about, what you're required to report and all of that. I'm more focused right now from the standpoint of assuming that people are familiar with this and maybe just trying to clear up if there's any confusion about what has happened recently. So, initially, entities that were formed before they had a January 1st, 2025 due date for submitting these new beneficial ownership reporting. And then there've been several court cases that have been going on for quite a long period of time. But up until about a month ago, those court cases were only impacting the specific plaintiffs in those cases. So like you were involved in those cases, and they would say, okay, you don't have to file right now because we're still figuring this out. But in December, they had a court in Texas that issued an injunction that then resulted in a nationwide injunction saying, okay, until we figure out whether this is constitutional and whatnot, nobody is required to file. So they put this injunction in place, and then they, technical thing. The filing requirement on hold for everybody. Then within a matter of weeks, they then lifted that injunction and put the filing requirement back in place. And when they did that, they only extended the filing due date from January 1st to January 13th. And then within days of that, they then put the injunction back in place. So as it stands right now, filing is only voluntary. So there are no consequences at this point for not having filed. And you can see up there that there's some different rules if that were in place if you were filed in 2024 or in 2025. But as of right now, everything is on hold. You can still file, but it's all voluntary at this point. However, as we saw, general consensus is that we probably haven't seen the end of this. And so the concern is that for people who have not filed, is that if they lift that injunction, that they're not going to give people a very long period of time to then, to then file. And I've got some information up there, and the reason why we were working so hard with our clients for education on this is because the penalties are pretty crazy. So it can be up to $500 per day. And then if they find that there was willful failure, you could actually be looking at criminal charges, up to $10,000 in penalties, 2 years of imprisonment. And so, it's pretty severe. Those penalties are similar to what apply if you have foreign bank account reports. There are annual filing requirements for that. So the penalties are very similar to that. And actually, it's the same organization that handles these beneficial ownership reports that is also the same organization that you would file foreign bank account reports with. So that is the FinCEN, the Financial Crimes Enforcement Network there, and you can go to their website for more information on that. And actually that statement up here on this slide is what is currently on the FinCEN.gov, which I have up there. So again, just to clear up any confusion, as of right now, filing is voluntary. And then I've got a note on there that, again, if you have not filed, that you probably want to be monitoring that status and watching that FinCEN website in case they do reinstate that requirement, and just being aware because they may not give a long extension on that. This is just my disclosure here of that any contents is not to be constructed as tax advice, and that's enough on that. I will end here just with my contact information up there, but that's all I had for today.
Okay, perfect. Thank you so much, Alana. And I know that this got brought up as a Q&A, but just wanted to reiterate to everyone, we will be sharing the slides as well as the recording. So you will be able to review everything that we covered here as well. Okay, and now we will go ahead and pass it over to Chloe Feingold, a financial advisor at Edward Jones. Take it away, Chloe.
Thanks, Madison, and thanks, Alana, for the good background on accounting stuff. That sounds like they will find you and they will tax you, so be aware. Hi, everyone. I'm Chloe Feingold, a financial advisor at Edward Jones. So before we get started, I just want to get to know a little bit more about you guys and learning a little bit more about your predominant capitalization strategy, which basically means where does the money come from to build your company. So for everyone on Zoom, feel free to engage with Madison, but for people in this room, we'll raise hands. So raise your hands if you plan on funding your company through venture capital or angels. Okay, maybe? Cool. You don't have to have it doesn't have to be certain. You can change your mind at any time. I'm not going to hold you to it. You got some flexibility here. Raise your hand if you plan on bootstrapping, which means the money comes from your bank account to build your company. Okay, cool. That's a lot of us. Raise your hand if you're planning to take on alternate funding like grants or debt. Okay, cool. So yeah, definitely we should talk more about those different types of funding. The one thing you all have in common is there's going to be cash flow in and out of your company before you even get to revenues, right? Somehow, some way the money has to come in to build it. And whether it's your money on the line or someone else's, having a smart capital management strategy in the beginning can help you get the most out of whatever you take on. So how many of you have thought about receiving the capital, but not put too much thought into where you're going to keep it while it's waiting to be spent? Anyone? If you plan to keep all your company's funds in a bank account, raise your hands. Kind of. Okay, cool. I'd like to hear about the other options later. If you raise your hand, you're taking the same path most founders do. Whether it's your own capital or investor money, most people take that money and put it into a bank account. There are a couple things about bank accounts that are important to point out. You are insured up to $250K at each FDIC insured institution. That's great, right? Well, let's say you've raised $2 million. Only $250K of that $2 million is protected. So you're not getting any added protection by keeping it all in one place. In fact, you're taking on a bit of risk. So we'll pivot to share a little background on me. Before I was with Jones, I actually worked at Silicon Valley Bank. Some of you may have heard of it in the last little bit for that, like tiny failure issue they had. I left about 5 months before the crash and was totally unaware that there would be any problems. And it's possible part of the reason they did have problems was because I left, but that's debatable. The bank failure really brought up an important point though. What happens when all of your money is kept in one place and you can't access it? The most common problem wasn't about losing funds because the depositors were actually protected, but the companies who had all their company cash in one account couldn't access any of the money until the issues were resolved. It didn't get fixed overnight, so some companies were unable to touch their corporate cash for weeks, which meant they couldn't pay vital expenses like payroll. Payroll isn't one of those things you can pay late. Or if you do, there's serious consequences, and some of the companies at the bank were in deep water at the possibility of not being able to pay these expenses. And that's just one example of why it's important to diversify. So some of you have probably heard of diversification before. It's pretty much summarized by the idea that you don't want to keep all your eggs in one basket. And many people think of diversifying their investments, but not where they keep their money. But both where you keep your money and how you allocate it are important things to consider. As one more example of this, there was a credit union that got hacked. It took a few days to resolve, but I knew people who had money due for things like rent and couldn't access it. One of the ways around this was to keep money in other institutions like Edward Jones, which is a brokerage firm. So you might be wondering, aside from my riveting tales of bank crises, what do I do? I'm a financial advisor and I help businesses, both for-profit and nonprofit organizations. Madison, sorry.
You're all good. We just had a question online. What if you break it up into several 250K accounts?
Yeah, so you're insured up to 250K at each FDIC insured institution. So there is a benefit. Obviously, you don't want to have like 25 bank accounts. Like that's a little bit much, but that's part of the reason we talk about this is, okay, where can you keep your money to make sure you're more protected and more of the money is protected? And how do you protect your money? And also, again, what risk are you taking on and what strategies are you using to mitigate it? So
Thank you.
good question. So I help companies most effectively use their capital to achieve their goals. I also help with succession and exit planning, employee benefits and education, insurance, and pretty much anything that your business will have to do that touches a dollar sign, except for taxes. And I also frequently work with individuals who are looking to accomplish a goal because honestly, starting a family, buying a house, any major life milestone is not that much different in a planning capacity than businesses. So because of my background in entrepreneurship and working with startups for as long as I have built a really diverse network of resources and knowledge that I'm here to share. So don't ever be afraid to ask me anything. I always say, ask away. And if I don't know, I probably know someone who does. So just ask anyway. So back to the topic at hand. We started talking a little bit about different ways to position your company cash. And so what are some of the things that you can do with it? Along with most people just putting money in a bank account, it frequently just sits, earning essentially 0.0 nothing. This is an immediate way that business owners lose money by not capturing interest on the money that sits in reserves. Think about it this way. If you have $1 million sitting in a bank account earning nothing, or $1 million earning 4% annually, which is actually a little lower than what the current interest rate environment offers. And there's a sheet in all your packets, and the Zoom people will get this later, I presume, that says interest rates at a glance. And that's all of the current interest rates for the market. So that's $40,000 a year. Let that sink in for a second. By putting your $1 million in an account that earns interest over the course of a year, you could potentially make $40,000 for free. That would be the same as me walking up to you and saying, do you want a check for $40,000, no strings attached? No matter how much you've raised, would anyone here today turn down an additional $40,000? If you're raising your hand, come find me after and we'll talk about why you would do that. Now you may be thinking $1 million seems really far off for me, but let's put it the other way. Let's say you're bootstrapping, funding it yourself, and you have 10K set aside to grow your company. It's not going to be $40,000 a year, but it's still something. It would be a few $100s of no strings attached, extra cash per year. The point is, it's never too early or late to utilize your money more effectively. So now you may be thinking, that's cool, but I studied risk and reward, and I assume in order to get that cash, I have to take on some risk, and that's bad. But I am here to tell you that there's risk, even in the safest options, like a bank, and the point of having a strategy is to mitigate unnecessary risk and put yourself in the best positions to succeed. So before we dive in more deeply, I'll pause here to take some questions. Does anyone have any? Yeah. Anyone on Zoom? We good? Cool. All right. So by now, I hope we've established that one thing every business owner needs is a solid plan for their capital and finances. And I want to provide some reassurance. If at any point today you're confused or don't know how to get started or feel like I'm literally just talking gibberish, don't worry, that's what I'm here for. Come ask me questions, we'll go through it. At this stage in your company journey, like Alana had mentioned, you're doing so much, right? You're doing marketing, sales, product development, investor relations, leadership, hiring, etc. And you don't have to worry about doing auxiliary things that don't help you grow your business. And I may be making some assumptions here, but I assume that's why most of us are here today, is to learn how to grow our businesses. Yeah.
Is SIPC limit the same as FDIC?
There are different types of protection, and it depends on which account you put it in. So that's a great question. So like a money market is SIPC protected and a CD is FDIC. So we can talk more about that depending on the strategy, but there's ways to balance both.
Thank you.
Awesome. All right. So What else are you guys thinking about at this stage? The first is your growth strategy, right? Many of you, especially in the early stage of your business, might be kind of in survival mode where you're like, I literally just want to get to the next day and I'm just trying to stay afloat, and thinking about actually how I'm going to do this in the long term is like way down the line. Well, you kind of got to start with that early, because doing things without a plan doesn't make it any better, because all you're doing is depriving yourself of a direction, right? Having a goal or a plan is a key step in understanding how you need to get there. So, for example, don't go too far down the rabbit hole of this. And I think we talked about having an HR person, but I'm sure there is an HR resource with SBDC. But think about hiring. Think about, who do you want on your team? How many people do you need? How much can you afford to pay them? What incentives and morale boosters can you provide, et cetera, et cetera. But one of the reasons I mention this is because it's important to think about what tools you'll need in place to serve the people that serve your purpose. And that's important. How will you help the people that are part of your organization build their futures, and how will you build your own? I knew that one time I talked to a startup and I brought up some things that larger companies have, like a 401k and all that. And they said they didn't want to do those because they wanted to seem like a startup and not a larger company. Trust me, when your office is 7 beanbags and a whiteboard, no one's doubting that you're a startup, but having a 401k definitely won't take that badge away from you. Okay. You're still a startup. Don't worry. But having a plan and being prepared in advance is a key element of being successful. That said, this is also way down the line, right? But one of the things to think about early is your exit strategy. At the beginning, you're thinking, how are you even going to think about how you're going to get out of this when you're barely just starting it? But the reason it's important to do so is because it may inform the steps that you're going to take to grow your company. For example, how much equity do you give away? What's your valuation? How many people do you hire? Who do you choose to run your company, et cetera? I always say start with the exit in mind. Do you want to IPO? Get acquired? Also, if this is also gibberish, come talk to me. We'll go through this. Just have a good business for yourself to live on for the rest of your life. Be a huge private company that you run. What do you want your company's future to look like? And along with that, what do you want your future to look like? So everyone on Zoom too, take 30 seconds to visualize your thoughts when someone asks you, what does your future look like? You can write it down. You can just brainstorm, and we'll pause here for a minute. Is this company your retirement? Is it a family business? Do you step away from it? What do you want to get out of all the blood, sweat, and tears you're putting into this endeavor right now? All right, hopefully everyone had some good thoughts. This company is a big part of your life, so keep in mind why as you go through this process. Why are you doing this? There are a million bajillion things you could be doing. So why this? A goal, even one that's not completed, is better than having no goal at all. And this presentation could go on for hours because of how important this stuff is. But what I hope you got out of today is that you have resources and you do not have to accomplish and figure all these things out by yourself. You have the resource, you have the SBDC, right? You have Alana, you have myself, you have your network, and all of the bullets on this side of the screen are briefly things that we touch for businesses and help with. So if anything struck a chord with you today, come find me. We'll set up a time to talk. We'll go through your personal situation and put you on a plan and a path that you feel good about. So thanks for listening, guys, and happy to take more questions if anyone has them. A quick note on the regulatory side of things, because we also have compliance and regulatory stuff. There is an act coming out called the Secure 2.0 Act, and everyone should have a handout on the Secure 2.0 Act. It's going to be a big change for small businesses, and basically says by the end of the year, every business with more than one employee will have to have a retirement plan in place. So it doesn't have to be a 401k, it could be, but thinking about if you're going to hire this year, what does that look like, right? And don't just go hiring willy-nilly and then be like, oh no, it's December and I don't have a 401k, because the fines can be pretty substantial. So we want to protect you. Both Alana and I are really in the job of protection and helping you get set on the right path, so you don't find out too late there was something that you needed to do. So that's all for me.
Okay, great. Thank you, Chloe, and thank you, Alana, as well. We're just going to open it up if anybody has any questions online or in person.
Yeah.
Do you have like a minimum for someone to like
No.
see you or okay?
That's a great question. So the question, yeah, this is the right way. The question was, do I have a minimum? So I don't do minimums because, again, there's a lot of people that need help that don't have access to it. Typically, financial advisors really won't talk to you unless you have like $250,000 or you're paying $400 to $500 an hour, which is like very unreasonable for small businesses and people just getting started. I always say there's essentially 3 groups that I really deeply serve: friends, family, people I like, young people and new investors, and then businesses, for profit and nonprofit. So yeah, no minimums. Come talk to me. And questions are always free. Talk is cheap. So